You've heard this your whole life. If you borrow too much, eventually someone comes to collect. That's just how debt works. Except here's the part nobody says out loud. Every single country on earth is in debt. The United States, Japan, Germany, Canada, the UK, Australia, every one of them, trillions deep. So if every nation on the planet owes money, who the hell is collecting? Most people picture global debt like a personal loan. Somebody lends, somebody borrows, somebody gets paid back with interest. Clean and simple. That model is not just incomplete, it is completely wrong. And that exact misunderstanding is why most people never see financial crises coming until they're already living inside one. By the end of this video, you'll know 3 things most people never figure out. Exactly who holds the world's debt and why their identity will shock you. Why this system keeps functioning, even though it looks mathematically impossible. And what the current shift in global debt means for your savings, your job, and the next crisis. Because history guarantees there will be one. This is an abstract theory. The global debt structure is fracturing right now faster than at any point since the collapse of Bretton Woods in 1971. What you understand after this video will permanently change how you read financial headlines. Before we go deeper, sit with this paradox for a moment. The countries that owe the most money are also the countries that print the money that debt is measured in. And the countries doing the lending, the so-called creditors, are themselves running deficits and borrowing billions to keep their own lights on. So is this whole thing just an elaborate illusion? A system that only survives because everyone agrees to keep pretending? Or is there real structural logic underneath logic that gets kept deliberately complicated so most people never bother looking? Here's my honest answer. Both things are partially true. And that combination is precisely what makes it genuinely dangerous. We're going to peel this back layer by layer. And I'll tell you right now, the biggest reveal isn't at the end. It's coming in the next few minutes. Stay with me. The creditor living in your retirement account. Here's the thing that immediately breaks the mental model most people walk around with. The biggest creditor in the world isn't China. It isn't Saudi Arabia. It isn't some shadowy international banking cartel. It's you, or more precisely, it's your pension fund, your 401k, your insurance policy, and your money market account. Picture this. You're 38 years old. You've been contributing to a 401k for a decade. You don't manage it directly, your fund manager does. And what does that fund manager do to keep your retirement safe? He buys government bonds, treasury securities, considered the safest asset on earth. So right now, without ever choosing to, you are one of the lenders. You are holding government debt. The US government owes you through that fund a portion of its $34 trillion obligation. This isn't an edge case. Pension funds, insurance companies, mutual funds, and money market accounts together hold the dominant share of most Western government debt. In the United States alone, roughly $27 trillion of the $34 trillion national debt is held domestically by American institutions, American investors, and the Federal Reserve itself. As economist John Kenneth Galbraith observed decades ago, the study of money, above all other fields in economics, is one in which complexity is used to disguise truth, not reveal it. The truth here is simple. Most government debt is money a country owes to its own citizens, pooled through financial institutions. What this means practically. When politicians scream about the national debt being a crisis that will destroy your children's future, they're technically describing money the government owes to pension funds that are your children's future. Cutting the debt aggressively means cutting payments to those funds. It's not a foreign enemy getting paid, it's retirement accounts, insurance pools, and domestic investors. That doesn't make unlimited debt harmless, but it changes the moral framing completely. But here's what that domestic picture still doesn't explain. Roughly $7 to $8 trillion of US debt is held by foreign governments. And those foreign creditors, they're caught in a trap they walked into willingly. And now they can't get out. The trap the creditors built for themselves. Japan holds about $1.1 trillion in US Treasury bonds. China holds around $775 billion. The UK, Luxembourg, Belgium, all significant holders. These are real creditors with real claims on American economic output. So why don't they just demand repayment? Why doesn't China say, pay up and watch Washington scramble? Imagine you lent your neighbor $400,000 15 years ago. He's been paying interest reliably, but the principal keeps growing. One day, you decide you want it all back immediately. So you announce it publicly. Here's what happens next. The moment word gets out that you're pulling your money, every other lender your neighbor has gets nervous. His credit rating craters. The value of the existing bonds you're holding, the ones you haven't cashed yet, drops sharply. The currency, those bonds, are denominated in weakens. By the time you've finished collecting, you've destroyed 30% of the value of what you were owed. You didn't win. You just blew up your own investment trying to punish someone. That's the China-US debt relationship. China cannot aggressively dump US treasuries without tanking the value of the treasuries it still holds. It cannot stop buying dollars without weakening the export markets that fuel its own economy. The creditor is trapped by the size of its own position. This is what economists call the balance of financial terror, a phrase coined after the 2008 crisis to describe exactly this mutual vulnerability. Lawrence Summers, former US Treasury Secretary, described it starkly. The relationship between the US and its foreign creditors resembles a situation where we owe them money, but they need us to owe them money. For you, this means geopolitical threats involving debt. China calling in American debt as a weapon are largely theater. The mechanism sounds scary. The actual execution would devastate the attacker as much as the target. Understanding this makes you immune to a category of financial panic that the media recycles every few years. But if foreign governments are trapped and domestic institutions are the main holders, then the real question becomes, what happens when the system itself starts to strain? Because right now, something fundamental is shifting. And it's something most financial commentary is completely missing. The hidden engine central banks and the debt that talks to itself. Here's the strangest creditor of all, and this one genuinely sounds like a conspiracy theory until you understand the mechanics. The US Federal Reserve holds approximately $4.5 trillion in US government debt. The Bank of Japan holds Japanese government bonds equivalent to more than 100% of Japan's annual GDP. These central banks, created by their own governments, are the single largest individual creditors their governments have. Which means, in a very direct sense, these governments owe money to institutions they created, that they appoint the leadership of, and that can effectively cancel or restructure that debt through policy decisions. Think of it this way. Imagine you owe $50,000 on a credit card, but you own the credit card company. You set its interest rates. You appoint its CEO. You can change its policies. Is that really debt in the way your mortgage is debt? Or is it a different category of obligation entirely? That's the question economists are genuinely divided on. And the answer matters enormously because during COVID, the Federal Reserve purchased trillions in government bonds in a matter of months. Governments spent. Central banks absorbed the debt. Inflation followed, which effectively eroded the real value of that debt over time. Milton Friedman famously argued, inflation is always and everywhere a monetary phenomenon. What he meant and what played out after 2020 is that printing money to absorb debt doesn't make the debt disappear. It redistributes the cost invisibly through price increases onto everyone who holds cash or fixed incomes. For you personally, inflation is, in a very real sense, how governments quietly pay down debt without politically painful tax increases or spending cuts. Every time your grocery bill climbs while your salary stays flat, part of what you're experiencing is the hidden debt repayment mechanism of modern economies. You are, without ever signing anything, participating in the settlement of government obligations. So domestic holders, trapped foreign creditors, and self-owing central banks together, they explain who the creditors are. But they still don't explain why the whole thing doesn't collapse under its own weight. That answer is stranger than most people expect. Why the system doesn't implode, the poker table nobody can leave. Global debt has been growing for a century. And for a century, people have been predicting it will collapse. It hasn't. Not because the warnings were wrong, but because most people misunderstand what would have to happen for it to actually fall apart. Picture a poker table, 10 players. Over the course of the night, every player borrows chips from every other player to stay in the game. By midnight, everyone at the table owes everyone else something. Now imagine one player says, I want out, pay me everything you owe me right now. The table collapses. Nobody gets paid in full. The player who called it in gets less than if he'd stayed. So everyone keeps playing. Not because the debts are sustainable forever, but because stopping is immediately more painful than continuing. That is the global debt system. The United States, Europe, Japan, China, they are all at the table. The moment one major player forces a hard stop, the contagion hits every other player's balance sheet simultaneously. The system persists not because it's healthy, but because exit is catastrophic. Ray Dalio, founder of Bridgewater Associates and one of the most studied macro investors alive, has written extensively about this dynamic. Long-term debt cycles typically span 50 to 75 years, ending not in a single crash, but in a slow, managed restructuring, or an inflation so severe it functions as an invisible default. We are, by his framework, in the late stages of a long-term debt cycle that began after World War II. For you, this reframes how you assess financial risk. The question isn't if there will be a significant debt restructuring event in your lifetime. History says there will be. The question is what form it takes: sharp crisis, prolonged inflation, or coordinated reset, and how positioned you are when it arrives. People who understood this before 2008 made very different decisions than people who were blindsided. And here's where we need to talk about what's different right now, because something has genuinely changed since 2020 that makes the next decade unlike the last 50 years. What's fracturing right now and what it means for your life? For 70 years, the global debt system ran on one silent assumption: that US Treasury bonds were the ultimate safe asset. Every country, every institution, every central bank treated them like the financial equivalent of gravity: reliable, permanent, unquestionable. That assumption is being stress tested right now in real time. Imagine you've been using the same bank for 30 years, perfect reliability. Then, one day, you notice the bank starts making decisions that seem erratic. Interest rates swing unexpectedly. Leadership changes. The terms of your account shift without clear explanation. You don't immediately pull your money, but you start thinking about it. You start looking at alternatives. That's the quiet conversation happening in finance ministries across Asia, the Middle East, and parts of Europe right now. Not a dramatic exit from the dollar system. Not a sudden dumping of treasuries. A slow, deliberate times, diversification away, times into gold, into bilateral currency agreements, into alternative reserve assets. The share of global reserves held in US, the dollars has dropped from roughly 71% in 1999 to under 58% today. That decline doesn't sound dramatic, but in the reserve currency world, it's tectonic. For you, a world where the dollar is one significant reserve currency rather than the unchallenged dominant one means higher borrowing costs for the US. Government long-term, which means higher interest rates across the economy, which means your mortgage, your car loan, your business credit, all more expensive. This isn't theoretical. The transmission from reserve currency status to everyday borrowing costs is direct and documented. So let's close every loop we opened. Who are the creditors when every country is in debt? First times, your own retirement savings and domestic institutions are the largest creditors of most governments. The debt crisis you fear is partly a crisis owed to your own future self. Second times, foreign governments are creditors, but they are structurally trapped. Their leverage is far smaller than it appears because using it destroys them as surely as their target. Third times, central banks have become the creditors of last resort, absorbing debt through money creation and distributing the cost invisibly through inflation, which you pay every single time prices rise faster than your income. Fourth times, the system persists not because it's sound, but because the alternative is immediately worse for every participant simultaneously. That's not stability. That's a shared, rational reluctance to pull the trigger. And fifth times, something has genuinely shifted. The slow diversification away from dollar dominance means the cushion that has absorbed American debt expansion for 70 years is quietly thinning. The Economist Times' Kenneth Rogoff, Times of Harvard, who co-authored the landmark study, This Time is Different. A historical analysis of 8 centuries of financial crises put it plainly. No financial crisis looks like the last one, but the underlying arithmetic of too much debt is always the same. The arithmetic is the same. The players have just gotten bigger. Here's where I'll leave you. You now understand something that the majority of people consuming financial news never think to ask. You see the architecture underneath the headlines. That's genuinely useful and genuinely rare. But this story isn't finished. The next chapter involves something we haven't touched yet. What happens when the debt restructuring actually begins? What historical precedents tell us about how it unfolds? And most importantly, what ordinary people can actually do to be positioned on the right side of it. That video's coming. If you don't want to miss it, you know what to do. Subscribe, hit the bell, drop a comment below with what surprised you most from today. The comment that makes me think hardest gets a direct reply. The question isn't whether the system changes. The question is whether you understand it well enough to see it coming.